You know, if you're over 50 years old and you're watching this right now, I want you to ask yourself something. What's the single smartest financial move you can make today that doesn't require you to take wild risks, doesn't demand that you become some Wall Street wizard overnight, and doesn't keep you up at night worrying about whether you've made a terrible mistake? I've spent more than 7 decades thinking about money, watching it work, watching it disappear, and watching ordinary people make both brilliant decisions and catastrophic errors. And I can tell you this with absolute certainty. The answer to that question isn't complicated. In fact, it's so simple that most people overlook it entirely. They're too busy chasing the next hot stock tip or worrying about what they should have done 20 years ago. But here's the truth, and I mean this from the bottom of my heart. You don't need to be young to make smart investments. You just need to be wise enough not to waste the years you still have. So settle in, because what I'm about to share with you isn't just investment advice, it's a philosophy that's guided me through boom times and crashes, through moments of absolute terror in the markets and periods of irrational exuberance. And it works especially well for folks who've got a few decades of life experience under their belt. Let me start with a story. Back in the early 1950s, I was just a young man, barely out of college, working for my mentor, Benjamin Graham, in New York City. Ben was already in his 60s then, and he'd lived through the Great Depression, seen fortunes evaporate overnight, watched supposedly smart people jump out of windows because they'd bet everything on margin and lost. But Ben, he had this calm about him, this certainty. And one day, after I'd been pestering him with questions about whether we should buy this stock or that stock, he looked at me over his reading glasses and said something I've never forgotten. He said, "Warren, investing isn't about being clever. It's about being sensible and patient." Now, I was young and ambitious, and part of me wanted to be clever. I wanted to outsmart everyone else. But over the years, I realized that Ben's wisdom was the real secret. Being sensible and patient beats being clever every single time, especially when you're at a stage in life where you can't afford to gamble with your financial security. So here's my number one investment tip for those over 50, and I'm going to say it plain. Focus on preserving what you have while letting compound interest do the heavy lifting for the years ahead. That's it. It's not sexy. It won't make you feel like a genius at cocktail parties, but it works. It's worked for me. It's worked for millions of ordinary Americans, and it'll work for you if you let it. Now, let me break down what I mean by that, because there's more wisdom packed into those few words than you might think at first glance. When you're young, say in your 20s or 30s, you've got time on your side. You can take a few risks, make a few mistakes, and still recover because you've got 30 or 40 years of earning power ahead of you. But when you're over 50, the game changes. You might have another 15 to 20 good working years, or maybe you're already retired. Either way, you can't afford to lose a big chunk of your savings on a speculative bet that doesn't pan out. I've seen too many people in their 50s and 60s get seduced by promises of quick returns, by cryptocurrency schemes, or penny stocks or somebody's can't miss investment opportunity, only to watch their nest egg shrink by 30 or 40%. And here's the brutal truth. At that age, you probably don't have enough time or earning power left to make it back. That's why capital preservation becomes priority number one. Before you think about growing your wealth, you need to protect what you've already built. Now, when I talk about capital preservation, I don't mean stuffing money under your mattress or keeping everything in a savings account earning next to nothing. Inflation will eat away at that just as surely as a bad stock pick. What I mean is investing in a way that minimizes the risk of permanent loss while still giving your money a chance to grow. And the best way I know to do that is through a simple, low-cost index fund that tracks the American economy. I've said this for years, and I'll keep saying it until I'm 6 feet under. For most people, a low-cost S&P 500 index fund is the smartest investment they'll ever make. It's not exciting, but it works. Over the long term, and by long term I mean 10, 20, 30 years, the American economy has grown and the stock market has reflected that growth. There have been crashes along the way, sure. In my lifetime, I've lived through recessions. The 1970s stagflation, the dot-com bubble, the 2008 financial crisis, and more recently, the pandemic panic. But every single time, the market has recovered and gone on to make new highs. Every single time. Let me tell you why I have such faith in this approach, and it goes back to something I learned not from books or business school, but from watching human nature and American enterprise for decades. See, when you buy an index fund that tracks the S&P 500, you're not betting on one company or one industry. You're betting on America's largest and most successful businesses all at once. You're buying a piece of Apple and Microsoft, of Johnson & Johnson and Procter & Gamble, of banks and energy companies and healthcare firms. You're diversified across the entire economy. And here's the beautiful part. You don't have to be smart enough to pick which companies will do best. You just have to believe that over time, American businesses will keep innovating, keep finding ways to serve customers, keep generating profits. And I do believe that. I've believed it my whole life, and nothing I've seen has changed my mind. Now, I know some of you are thinking, but Warren, the market feels expensive right now. Or what if I invest and then there's a crash? These are reasonable concerns, and I'm not going to dismiss them. But here's what I've learned over 70 plus years of investing. Nobody, and I mean nobody, can consistently predict what the market will do in the short term. Not me, not your broker, not the experts on television who sound so confident. The market might go up next month, or it might go down. It might crash next year, or it might soar. I have no idea, and neither does anyone else, no matter how smart they sound. But here's what I do know. Over long periods of time, the market goes up. It has to, because over long periods of time, businesses figure out how to create value, how to serve customers better, how to make profits grow. That's what capitalism does. It rewards innovation and efficiency. So if you're over 50 and you're worried about timing the market, stop worrying. You're not trying to time anything. You're trying to give yourself the best possible chance to grow your wealth safely over the next 10, 20, or 30 years. And the way you do that is by getting invested and staying invested through thick and thin. I like to say that the stock market is a device for transferring money from the impatient to the patient. If you panic and sell every time the market drops 10 or 15%, you'll end up selling low and buying high, which is exactly the opposite of what you want to do. But if you stay calm, if you keep holding through the turbulence, you'll end up being rewarded for your patience. Let me give you an example from my own life. In the early 1970s, we went through one of the worst bear markets in modern history. Stocks got hammered, inflation was running wild, interest rates were shooting up, and people were convinced that the American economy was finished. I remember reading headlines about the death of equities, about how stocks were a terrible investment and you should put everything in gold or real estate or whatever. But I kept buying stocks. I kept buying good businesses at reasonable prices, and I kept holding them. And you know what happened? Over the next decade, those investments made me and my shareholders a fortune. Not because I was smarter than everyone else, but because I didn't panic. I stayed rational when others were fearful. That's another principle I want you to remember, especially if you're over 50. Be fearful when others are greedy, and be greedy when others are fearful. It's one of my favorite sayings because it captures something essential about successful investing. When everyone around you is excited about the market, when your neighbors are bragging about their stock picks and the media is full of stories about people getting rich quick, that's usually when things are getting dangerous. Prices get pushed up too high, valuations stop making sense, and eventually the bubble bursts. But when everyone is scared, when the headlines are all doom and gloom and people are selling in a panic, that's often when the best opportunities appear. Stocks go on sale. Good businesses get priced at bargain levels. And if you've got the emotional fortitude to buy when others are selling, you can do very well. Now, I realize that's easier said than done. It takes real courage to invest when the world feels like it's falling apart. But that's where experience becomes an advantage for those of you over 50. You've lived through tough times before. You've seen crises come and go. You know in your bones that things eventually get better, even when they look darkest. That perspective is worth more than all the fancy financial models and algorithms on Wall Street. Use it. Trust it. When the next market panic comes, and it will come because they always do, remember that you've survived every previous downturn. You'll survive this one too, and your portfolio will recover if you just stay the course. Let me talk a bit about dividends because they're particularly important for folks in the second half of life. When you own stocks in good companies, many of them pay you dividends. which are essentially a share of the company's profits. These dividends get deposited into your account every quarter, and you can either spend them or reinvest them to buy more shares. Now, when you're over 50, dividends become a wonderful source of passive income. They're like getting a paycheck from your investments without having to sell anything. And if you reinvest those dividends, buying more shares each quarter, you create this beautiful compounding effect where your dividends generate more shares, which generate more dividends, which generate even more shares. It's like a snowball rolling downhill, getting bigger and bigger over time. I've always loved dividends because they're real. They're cash in hand. Unlike the fluctuating price of a stock, which can go up or down based on all kinds of emotions and speculation, a dividend is actual money that the companies send you. It's proof that the business is generating profits and sharing them with shareholders. And the wonderful thing is, many great American companies have been paying and increasing their dividends for decades. Companies like Johnson & Johnson, Coca-Cola, Procter & Gamble, these are businesses that have raised their dividends year after year after year through recessions and booms alike. When you own companies like that, you're not just hoping the stock price goes up. You're getting paid to wait and getting paid more each year. That's the kind of investing that makes sense when you're over 50. Speaking of Coca-Cola, let me tell you about one of the best investments I ever made. Back in 1988, I started buying shares of Coca-Cola. The company had been around for over a century, selling a product that people loved all over the world. It had a brand that was worth billions, a distribution system that reached every corner of the globe, and a management team that knew how to allocate capital wisely. I bought a huge stake in Coca-Cola, and I've held most of those shares ever since. Over the years, Coca-Cola has paid me billions in dividends, billions, and the stock price has gone up many times over. But here's what I want you to understand. I didn't buy Coca-Cola because I thought I could predict what the stock would do in the next month or even the next year. I bought it because I believed in the business for the long term. I believed that people would still be drinking Coke decades into the future, and I wanted to own a piece of that economic reality. That's the mindset I want you to adopt if you're over 50. Don't think about your investments as pieces of paper that you're hoping to flip for a quick profit. Think about them as ownership stakes in real businesses that serve real customers and generate real profits. When you frame it that way, it becomes much easier to hold through the inevitable ups and downs. You're not worried about whether the stock is up or down this week. You're focused on whether the underlying business is healthy and growing over time. Now, let's talk about something that trips up a lot of people, especially as they get older: the temptation to get too clever or too active with their investments. I can't tell you how many folks I've met who started out investing sensibly, but then got bored or overconfident and started trading more frequently, trying to chase performance, switching in and out of different funds or stocks. And almost always, this hyperactivity destroys returns. There's been study after study showing that the more people trade, the worse they do. Every time you buy and sell, you're paying transaction costs and taxes, and you're probably making emotional decisions based on recent performance rather than long-term fundamentals. It's a losing game. The best investment strategy is almost always the boring one. Buy a diversified portfolio of low-cost index funds, set up automatic investments if you're still working, reinvest your dividends, and then do as little as possible. Check in once or twice a year to rebalance if needed, but otherwise leave it alone. I know that sounds too simple. We live in a culture that celebrates activity and cleverness, but in investing, activity is often the enemy of results. The less you do, the better you tend to do, as long as you've set things up intelligently from the start. Let me share another story that illustrates this point. Years ago, I made a bet with a group of hedge fund managers. I bet them that a simple, low-cost S&P 500 index fund would outperform their fancy, actively managed hedge funds over a 10-year period. These were smart people, professionals who spent all day, every day analyzing stocks and making complicated trades. They had armies of analysts and sophisticated computer models. And I bet them that they couldn't beat a simple index fund. Well, 10 years later, the index fund won easily. It wasn't even close. The hedge funds, with all their activity and cleverness and high fees, got clobbered by the boring index fund that just sat there and tracked the market. That bet proved something I'd believed for a long time. For most people, the simple approach beats the complicated one. This is especially true when you're over 50 because you don't have time to recover from expensive mistakes. If you're paying high fees to an active manager who's churning your portfolio and underperforming the market, those fees and that underperformance compound against you over time. A 1% fee difference might not sound like much, but over 20 or 30 years, it can cost you hundreds of thousands of dollars in lost returns. So keep it simple, keep costs low, and don't let anyone convince you that you need complicated strategies or exotic investments. You don't. I want to talk for a moment about risk because I think it's misunderstood, particularly by people later in life. Most folks think of risk as volatility, as the day-to-day or month-to-month fluctuations in their portfolio value. And yes, volatility can be uncomfortable. It's not fun to see your account balance drop by 10 or 20% during a market downturn, but that's not real risk. Real risk is the permanent loss of capital. Real risk is investing in something you don't understand and losing money that you can't afford to lose. Real risk is being forced to sell stocks at the bottom of a market crash because you need the money and you can't wait for the recovery. That's what keeps me up at night, not temporary price fluctuations. So how do you minimize real risk when you're over 50? First, make sure you have an adequate emergency fund in cash or very safe liquid investments. You should have enough to cover at least 6 months to a year of living expenses so that if something unexpected happens, a medical bill or a home repair or whatever, you don't have to sell your stocks at an inopportune time. That cash cushion gives you the freedom to ride out market volatility without panicking. Second, only invest money that you won't need for at least 5 to 10 years. If you're going to need the money sooner than that, keep it in something safe, like a money market fund or short-term bonds. The stock market is for long-term money, not short-term needs. And third, diversify broadly through index funds rather than betting big on individual stocks unless you really know what you're doing. I've spent my career investing in individual stocks, but I'm a professional investor who's devoted 70 years to studying businesses. For most people, that's not realistic or necessary. And even I recommend that my own estate, after I'm gone, be invested mostly in low-cost index funds. That should tell you something. If I think index funds are the right choice for my own family's money, they're almost certainly the right choice for you too. Now, here's a hard truth that I need to share with you, especially if you're over 50. You can't go back and fix the financial mistakes you made in your 30s or 40s. Maybe you didn't save enough. Maybe you took on too much debt. Maybe you invested foolishly or not at all. I meet people all the time who are filled with regret about the past, about what they should have done differently. And I understand that feeling, I really do. But regret is expensive and it doesn't change anything. The only thing you can control is what you do from this moment forward. So if you're over 50 and you feel like you're behind where you should be financially, I want you to stop beating yourself up and start taking sensible action today. Even if you only have 10 or 15 years until retirement, making smart investment decisions now can make a significant difference in your financial security. Compound interest still works, even if you're starting late. Let's say you're 55 years old and you manage to invest $500 a month in a low-cost index fund that averages 7% annual returns, which is conservative based on historical market performance. By the time you're 70, you'll have contributed $90,000 of your own money, but your account will be worth roughly $160,000. That extra $70,000 is the power of compounding, of letting your money work for you over time. Now imagine if you could invest more than $500 a month, or if the market performs better than 7%, or if you have longer than 15 years. The numbers get even more impressive. My point is, it's never too late to start doing the right thing. Never. I also want to address something that becomes increasingly important as you get older: the psychological and emotional aspects of investing. When you're over 50, you've probably experienced enough of life to know that your emotions can lead you astray. Fear and greed are powerful forces, and they're responsible for most of the bad investment decisions people make. When the market is soaring and everyone around you is getting rich, greed tempts you to jump in at the top, to invest more than you should, to take risks you can't afford. And when the market crashes and the headlines are screaming about financial disaster, fear tempts you to sell everything and hide in cash, which usually means locking in your losses and missing the recovery. The key to successful investing is keeping your emotions in check. It's having the discipline to stick to your plan when your gut is telling you to do something else. And this is where age can actually be an advantage. You've lived long enough to know that your feelings aren't always reliable guides. You've learned, hopefully, that sometimes the right thing to do is the hardest thing to do, the thing that feels uncomfortable in the moment but turns out to be wise in hindsight. Apply that wisdom to your investing. When you're tempted to sell in a panic or buy in a frenzy, take a deep breath, step back, and ask yourself, am I making this decision based on logic and my long-term plan? Or am I reacting emotionally to recent events? 9 times out of 10, the emotional reaction is the wrong move. Let me tell you about one more principle that's guided me throughout my life and is particularly relevant for those over 50. Live below your means. This isn't strictly about investing, but it's absolutely essential to financial security. If you're spending everything you make, or worse, spending more than you make and going into debt, you'll never build wealth no matter how smart your investments are. But if you can live on 80 or 90% of your income and invest the rest, you're setting yourself up for a comfortable future. This becomes even more critical as you approach retirement. The gap between what you earn and what you spend is your margin of safety, your cushion against unexpected expenses and economic downturns. I've lived in the same house in Omaha for decades. It's a nice house, comfortable, but it's not a mansion. I didn't need a mansion, and spending money on one wouldn't have made me any happier. Instead, I invested the money I saved, and that money has compounded over the years into significant wealth. I'm not suggesting you live like a miser or deprive yourself of things that bring you genuine joy, but I am suggesting that you be thoughtful about the difference between what you need and what you want, and that you prioritize saving and investing over impressing other people with expensive things. As you get older, there's also something liberating about having less stuff. Possessions can become a burden. They require maintenance, insurance, space, attention. But a well-managed investment portfolio requires very little from you. It works quietly in the background, growing over time, giving you freedom and options rather than tying you down. That's the kind of wealth that matters, the kind that gives you security and peace of mind, not the kind that sits in your driveway or hangs in your closet. Now, let's circle back to where we started. What's the number one investment tip for those over 50? Focus on preserving your capital while letting compound interest work for you over the years you have left. Invest in low-cost index funds that give you broad diversification across the American economy. Reinvest your dividends. Keep your emotions in check during market volatility. Don't try to get fancy or clever. Stay the course through thick and thin. And perhaps most importantly, maintain perspective. Remember that investing isn't about getting rich quick. It's about growing your wealth steadily and safely over time so that you can live comfortably, help your family, support causes you care about, and enjoy the fruits of your labor without worrying about running out of money. I'm 95 years old as I'm talking to you today, and I've seen it all. I've seen fortunes made and fortunes lost. I've seen people make brilliant decisions and catastrophic errors. And here's what I know for certain. The principles I've shared with you today work. They've worked for me, they've worked for countless others, and they'll work for you if you embrace them. It's not magic. It's not even particularly difficult. It just requires patience, discipline, and the wisdom to keep things simple when the world around you is trying to make everything complicated. If you're over 50 and you've been worried about your financial future, I hope this has given you some clarity and some confidence. You don't need to be a financial genius. You don't need to spend hours every day managing your investments. You just need to make sensible decisions and stick with them. Invest in low-cost index funds, reinvest your dividends, keep some cash on hand for emergencies, live below your means, ignore the noise and the hype and the fear, and give yourself the gift of time because time is the most powerful force in investing. I started investing when I was 11 years old with a few shares of City Service preferred stock that I bought for $38 a share. I was terrified when the price dropped, and I sold too early when it bounced back to $40, only to watch it later climb to $200. That experience taught me something invaluable about patience and about not letting fear drive my decisions. Over the next 8 decades, I've made plenty of mistakes, but I've also built considerable wealth by following the principles I've shared with you today. And the beautiful thing is, you don't need 8 decades. You just need to start now and stay disciplined. One of the questions people ask me most often is what I worry about when it comes to investing. And honestly, at my age, I don't worry much about the stock market or the economy. Those things will fluctuate, as they always have. What I worry about is people making poor decisions out of ignorance or emotion, decisions that cost them their financial security. I worry about folks getting seduced by scams or get-rich-quick schemes, or panicking and selling at the worst possible time. I worry about people not taking advantage of the wonderful compounding machine that is the American stock market, simply because they don't understand it or they're too afraid to get started. That's why I keep talking about these principles, why I keep trying to educate people about sensible investing, because I know it works and I want as many people as possible to benefit from that knowledge. If I could sit down with each of you individually and give you advice tailored to your specific situation, I would. But since I can't do that, I'm giving you the next best thing. The core principles that apply to almost everyone, especially those of you in the second half of life. Take them to heart, put them into practice, and then have the patience and discipline to let them work over time. Don't check your portfolio balance every day. Don't read every scary headline or listen to every market pundit. Just keep living your life, keep investing regularly if you're still working, and trust that over time your wealth will grow. I'll leave you with one final thought, something I hope you'll remember long after you've finished listening to this. You don't need to be young to make smart investments. In fact, being older gives you certain advantages: perspective, emotional maturity, the wisdom that comes from experience. What you need is the sense to use those advantages wisely. Don't waste the years you still have by making reckless decisions or by being paralyzed by fear and regret. Make a sensible plan, follow it faithfully, and give yourself the best possible chance at financial security and peace of mind. That's the real secret, not some complicated formula or insider tip, but simple, patient, disciplined investing in great American businesses through low-cost index funds. It's worked for me, and it'll work for you. I promise you that. Now go out there and make it happen. Your future self will thank you. Remember to like and subscribe for the best investment strategies and advice inspired by Warren Buffett. Listen to our next audiobook in the series by clicking below.